Oftentimes, entrepreneurs and business people say they cannot afford to borrow money, even though their ideas are worthy of a loan. They claim this lack of credit is unfair, and governments should make up for the callousness of private lenders by providing loans. And governments often do. For example, in 2008, Investment Saskatchewan spent the equivalent of $35 per person on behalf of every Saskatchewan resident. Are such policies right? Or were private lenders trying to tell would-be borrowers something about the worthiness of their proposals? With me is David Seymour from the Frontier Centre for Public Policy. What are we talking about when we say credit?
Well, we start off with a borrower and a lender, and the borrower receives and agrees to pay back some amount of money with interest. The lender, on the other hand, agrees to give up spending now in exchange for a greater return in the future. Now, the interest rate is in the middle of all that. It's supposed to balance the risk of failure, so if some investments fail, on average, the lender gets his or her money back. If you thought, for example, that 1 out of 3 investments was going to fail, you'd need 50% return on the 2 successful investments to make up for the one you lost.
The interest rate is based on the lender's perception. What if the lender misjudges or puts loans out of some people's reach? Isn't that an unfair balance of power?
Well, I'm sure some rejected borrowers see it that way, and governments sometimes try to right this perceived unfairness with schemes that offer loans at lower rates than other lenders would offer. But in the end, governments don't create new opportunities by doing that. They just divert resources to less productive borrowers.
How so?
Well, if you focus only on the loan recipient, it seems as if a new business venture or whatever project the loan's being used for has come out of nowhere.
But of course, there are other groups and long-term effects.
Yeah, exactly. And governments have to get the money from somewhere. And in this case, you could say that they're taking it from would-be private lenders and making lending decisions of their own. Once you factor in the other borrowers who might have borrowed the same money from a private lender, you have a diversion of resources from would-be private borrowers to those favored by the government scheme.
That still doesn't answer the question of equity and fairness.
Well, it really depends on whether you're judging the borrower or the investment. Ultimately, it's the investment or the use of the loan that matters, not the actual identity of the borrower. And if you want to make people equal, there are other mechanisms for doing that. Variable tax rates and government benefits are just 2 of them. But when government loans favor some investments over others, they just ensure that resources go to less promising investments overall.
So if we agree that government loan schemes are a diversion of resources from the private credit market and that it's the investment rather than the borrower we're worried about, it still isn't clear why government lenders will pick worse investments. Aren't you just prejudiced against government projects?
Well, no, I'm not. And there are 3 basic reasons, or quite objective reasons, why government lending is going to be less effective than private. Government lenders don't have as direct a concern about whether they match the interest rate to the risk that's present in the investment. That's because they're not risking their own money. A good example of this was the reckless underwriting of mortgages by Fannie Mae and Freddie Mac in the run-up to the 2008 mortgage meltdown in the United States. Also, government lenders tend to lend money as part of schemes with ulterior purposes, such as maybe creating employment or boosting an industry rather than just getting a return on investment. So once again, the mortgage meltdown in the US was partially driven by the non-economic goal of lending to minorities under the Community Reinvestment Act. Now, these other purposes detract from the main task of making sure that the best investments are found by the lender. And finally, private investors are subject to a cruel but very effective test of natural selection. If you're not a good investor, then you won't have money to invest for very long. In this case, only the most astute investors survive. And as a government, if you can get taxpayers to stake you in and give you money to use in the investment business to start with when you don't have a track record, then you can probably find a way to stay in the investment business even if you have a bad record.
The best investment is something that sounds hard to be against. What is it exactly?
Well, it's important to remember that ultimately what's being diverted is not loans and it's not money or cash, but actually physical resources. When the borrower gets the money, it's used to buy things. So the borrower is ultimately deciding where a resource goes. In the case of a farm loan, for example, it could be a tractor. Now, the best investment is the one that's most likely to be repaid, and that's a question of consciously investigating the proposal in question.
So if all of this is so obvious, then it's hard to imagine that governments would bother getting involved in lending. Are there really cases of this happening in Canada?
Well, first, the fact that governments choose a policy doesn't mean it's a good one. The history of public policy is full of bad ideas that seem like good ones at the time. But secondly, there are current cases in Saskatchewan. We have a Crown corporation called Investment Saskatchewan, for example, and in 2008 it invested $35 million. And their mandate is to provide investment capital and financing for economic growth. Now, $35 million in Saskatchewan is not a huge amount of money, but it is about $35 for every person. And all of the above questions apply. We should ask, is this a provision, as they call it, or a diversion, as Hazlitt would call it? And why would employees at Investment Saskatchewan be able to pick better investments with that $35 than the average person whose taxes we use?
Well, we'll have to leave that for viewers to ponder. And to summarize, government lending always takes funds away from the private sector. Government lenders face lax incentives compared to private lenders. If uses of government loans were worthwhile, they wouldn't need government intervention. In our next episode, we look at the effects of new technology in the workplace. Does it make people wealthier or put them out of work? Until then, I'm Jamie Stevenson, and this has been On the Other Hand.